Welcome back to the Deep Dive. We're here to cut through the noise around corporate reports and market research for you. Today we're digging into Uno Minda Limited, or UML. They're a big deal in global auto components. We've got their Q2 FY26 results right here.
Yeah, we're looking at the investor presentation and the press release for the quarter ending September 30th, 2025. And honestly, this isn't just numbers on a page. It feels like a company really hitting its stride. The big headline, their highest ever quarterly revenues and profits. You can't miss that.
Right. So that's our goal today. We want to get behind those numbers, really understand what's driving this, this acceleration, and maybe even more importantly, look at their strategy, their big investment plan. We're talking thousands of crores here, all aimed at making sure they lead the way as we shift towards EVs and more advanced safety stuff.
It really is a story about balancing, their traditional strengths with this vision for the future. And the numbers, well, they suggest they're actually pulling it off pretty well.
Okay, let's jump into those big numbers then. Core financial strength, consolidated revenue for Q2 FY26, 4,814 crore. That's up 13.4% compared to last year. Solid double-digit growth.
It is solid, yeah. But what's really, I think, fascinating is how much faster the profit grew. That tells you something's clicking internally, efficiency-wise. Look at EBITDA, earnings before interest, taxes, depreciation, amortization, came in at 552 crore. That grew a bit faster, 14.4% year on year, and it nudged their margin up slightly, about 10 basis points to 11.5%.
Okay, 10 basis points on the margin is nice, definitely. But you're hinting the real action is further down.
Absolutely. The profit after tax, or PAT, that's the profit actually belonging to UML owners, that soared to 304 crore. That's a jump of 27.4% year on year. I mean, when your profit's growing more than twice as fast as your revenue.
Yeah, that signals some serious leverage, right?
Exactly. Serious leverage.
So 27.4% PAT growth versus 13.4% revenue growth. We hear operational efficiency thrown around a lot, but what does that actually mean here? What's behind those extra 69 basis points of P margin?
It's quite a gap. Yeah, it suggests, I think, two main things are happening. First, strong operating leverage, like you said. They're clearly filling up capacity. So the cost of making that extra 13% worth of stuff is relatively low. And second, probably a favorable product mix. Meaning the stuff that's growing fastest, maybe things like airbags or ADS systems, high-end lighting, perhaps those tend to have higher margins anyway. So they're pulling the average profitability up.
Got it. Okay, so the underlying business health looks really, really strong. And that extra profit went straight to the shareholders, right? Diluted earnings per share, 5.27, up almost 24% year on year. And you look at the first half of the year, H1 FY26. It wasn't just a one-off quarter. Revenue grew 14.5%, PT net 24.3% over 6 months. So the momentum seems real.
Definitely seems sustained.
Yeah.
So the big question then is, what created this momentum? Management, folks like Mr. Ravi Mehra and Mr. Sunil Bora, they mentioned the macro environment, sure, but they specifically called out GST 2.0 reforms.
Okay, GST 2.0 reforms. That might sound a bit like jargon to some listeners.
Yeah.
What's the practical impact for a company like Uno Minda?
Well, for big component players, these GST changes have really helped smooth out the whole supply chain. Logistics, too. It's about less friction, Better use of input tax credits, simpler warehousing, lower costs overall. And when that happens, it gets cheaper and easier for the car makers, the OEMs, to buy components. That boosts demand. Plus, it helps the suppliers' own cash flow, their working capital.
Ah, okay. So stability, affordability, those were key. Plus, you had the usual festive season boost helping consumer confidence. And we can see that confidence in the wider market numbers they shared for Q2.
Exactly. If you break down the auto industry numbers for that quarter, it was pretty healthy across the board. Passenger vehicles, PVs, grew 4%. Steady. But the real volume drivers were two-wheelers and commercial vehicles, CVs, both up a strong 11% year on year. And even the off-road segment, kind of specialized, that surged 15%.
So a broad recovery. But let's link that back to Uno Minda specifically. Which parts of their business really turned that general industry improvement into that 27% profit jump?
Right. So the foundations are still strong, Switches, lighting, casting, seating, those are the big volume drivers. But it looks like two sort of more specialized areas really drove the margin expansion. First, airbags. That business saw really robust growth. And that's directly linked to stricter safety rules, right? Plus, they expanded their Nimrana plant, which let them move into more complex stuff like side and curtain airbags. That's higher value.
Higher value, higher margin, presumably. Okay, and the second area?
Sensors and ADAS advanced driver assistance systems. That whole area is scaling up fast. They commissioned a new camera module production line just this quarter. That's crucial. Again, this is sophisticated tech, not just basic parts. Oh, and we shouldn't forget seating either. That grew quite a bit too. They managed to get new two-wheeler customers, and they're supplying more suspended seats domestically.
Right. It definitely sounds like they're targeting the higher value add segments pretty strategically.
Yep.
If you look at their revenue mix for Q2, switches are about 25%, lighting 23%, casting 20%. Those are the big three. And segment-wise, it's pretty balanced, isn't it? Almost half from two-wheelers, 48%, half from four-wheelers, 45%.
Yeah, that balance is a strength. But here's a really key strategic point, I think. It gives them massive protection. Over 95% of their products are what they call powertrain agnostic.
Okay, let's pause on that. Powertrain agnostic. Why is that phrase so critical right now?
Well, it basically means they aren't betting the farm on the internal combustion engine sticking around forever. They sell the fundamental bits, switches for the windows, seats, lights, stuff you need, whether there's a petrol tank or a battery underneath. So their core business is kind of shielded from the whole EV disruption. They're betting on the car existing, not necessarily the engine type.
That's a smart buffer to have. But the goal isn't just to survive the shift, it's to win, right? So the real growth story, long term, has to be about selling more stuff into each EV. And this is where the numbers get, well, pretty mind-blowing, especially for two-wheelers.
Yeah, they actually put some numbers on this potential increase, and it's huge. Get this. For a standard internal combustion engine, ICE, two-wheeler, UML's kit value is around $11,936. But if that same bike goes electric, the potential value of the kit they could supply jumps to $37,636.
Whoa, hang on. That's more than 3 times the revenue potential.
Yeah.
Just because the powertrain changes. That difference, that is the strategy right there.
It absolutely is. And to grab that huge extra value, they're really focusing hard on developing and making the specific EV parts. We're talking low-voltage EV products, things like battery management systems,
Right.
BMS,
Yeah.
onboard chargers, off-board chargers, and also this thing called AVAS, the Acoustic Vehicle Alert System. That's becoming important.
AVAS is interesting because that's not just driven by market demand. There's a regulatory push too, isn't there?
Exactly right. The government's actually proposing rules to make AVS mandatory. The sound emitters for quiet EVs. It looks like it'll be required for new models after October 2026, and existing models need it by October 2027. So, yeah, that's basically a guaranteed future market for one of their key EV products.
Okay, so the financial strength is there, the strategy seems clear, but making this kind of massive shift costs serious money. Let's talk about that 2,356 crore investment plan.
Yeah, this is a major, major commitment. Management confirmed they're pushing ahead with 2,356 crores in capital spending. It's spread across 10 key projects, all aimed at boosting capacity, especially in those high-growth areas we've been talking about.
That number, 2,356 crore, it's huge. That's a big chunk of their yearly profit. Is this a bit of a gamble on how fast EVs take off? Or is this capacity likely backed by solid orders from the car makers?
Well, given that 93% of their revenue comes directly from OEMs, it's highly likely this spending is linked to confirmed orders or at least very strong long-term agreements. I'd see it less as a speculative bet and more like they have to build this capacity to meet the demand they know is coming. They can't sell that 37,000 EV kit if they don't have the factories ready to make the parts, right?
Makes sense. Okay, so can you give us some examples? What are the big projects and when do they expect them to start producing? The SOP dates.
Sure. The expansion is pretty broad. The 4W alloy wheels plant up in Carcota. Phase 1 is apparently being commissioned right now. That's going to add capacity for 60,000 wheels a month. That's a lot of premium wheels. And then you see the clear EV and safety investments.
What about timelines for the new safety stuff and those premium components?
Okay, so the brand new airbags plant in Harrow Holly, that's a critical high-margin safety part that's expected to start operations in Q1 of FY27. They're also building a completely new facility just for sunroofs down in Bowal. That taps into that whole premium trend in cars here. The SOP for that one is penciled in for Q4 FY27.
And the really crucial one, the plant specifically for the EV powertrain components.
Yep, the dedicated 4W EV powertrain products plant in KED. That's also being built right now. Phase 1 of that should start producing in Q2 FY27, so mid-2026 roughly. And that links right back to those high-value BMS systems, chargers, all that stuff we talked about. It really shows they're putting their money where their mouth is, strategy-wise.
And just on the corporate side, they tidied things up with their EV division too, right? They bought out the remaining stake in Uno Minda EV Systems, brought that whole thing, including assets in Germany and Vietnam, fully in-house.
Yeah, that consolidation makes sense. It brings all the R&D and manufacturing control under one roof. That's pretty vital when you're dealing with complex, fast-moving tech like EV systems. And just as a governance check, the board signed off on these strong results. They also confirmed that the money raised from those non-convertible debentures earlier in the year was used properly. No issues there. Oh, and worth a mention, their group CFO, Mr. Sunil Bora, picked up a big award, the CII Best CFO Award, recognition for the finance team.
Okay, so let's try and wrap this all up. If you had to boil it down, what's the key thing for our listener to take away from all this?
I think the key thing is duality. That's the word that comes to mind. Uno Minda is doing two things really well at the same time. On one hand, they're absolutely crushing it with their traditional high-volume part switches, lighting, thanks to the broad economic recovery that's generating huge cash flow. And on the other hand, they're taking that cash and investing very heavily, very aggressively in the future, specifically in those high-value, high-margin areas, EVs, ADAS, premium bits like airbags and sunroofs. That 27.4% profit growth, that's basically the old business funding the R&D and CapEx for the new tech-focused business.
Yeah, it really looks like they're executing a long-term plan looking maybe 3-5 years ahead, and they're funding it through sheer operational excellence right now.
Absolutely. You can see the shift happening. They're moving from just being a part supplier towards being more of a high-value tech partner for the OEMs.
Okay, so final thought then. Something for you, the listener, to think about. We mentioned that huge split, and 93% of their revenue this quarter came from OEMs, the big manufacturers. Only 7% from the aftermarket selling parts directly to consumers or garages. But they have this absolutely massive distribution network already built. Over 100,000 places globally where their parts are available, 1,600 business partners just in India. It's huge. So here's the question for you to ponder. Given how much they rely on those big OEM contracts, which can swing up and down quite a bit, how quickly can Uno Minda really start using that enormous existing network, those 100,000 plus touch points, to seriously grow their B2C aftermarket sales, both here and internationally? And what tools, maybe like that internal AI forecasting thing they mentioned, Star, what's needed to turn that physical network into a much bigger, maybe more stable, high-margin revenue stream, one that could maybe cushion them if OEM volumes fluctuate?
That's a great point. Scaling up that B2C side, the aftermarket, that's a whole different ballgame. It needs different skills, different marketing, different tech compared to supplying huge factories. But if they could unlock even, say, double that 7%, tap into that network more effectively, it could really change the risk profile of the whole company, make it less dependent on those big contracts.
Definitely something to keep an eye on over the next few years. All right, that's our deep dive for today. Thanks for tuning in, and we'll catch you next time.